Um, optimized trading was started in 2014 with my business partner. He's more of the client specialist, so to speak, and I designed the products. We realized that we could accomplish more together than we could independently, and so we started back in 2014, really building out the underlying concepts and foundations of what our concepts would be and strategic models would be in the markets that we would focus on for our firm in the future. So we primarily focus on markets that have a linear bias, so large cap stock sector index, smart beta ETFs, index bond, crude gold futures. Before we get into some product and service reviews, read the disclaimer. All right, historical performance may not be indicative of future results. Trading or investing may carry a high degree of risk, not suitable for every investor. We do not claim or guarantee our products will perform positively or reflect our historical performance. In fact, there can be significant differences between historical and future results. Investors should only choose to invest funds they can afford to lose without negatively impacting results. Please carefully review any trading product or service before activation. Please consult your investment professional before selecting any trading or investing strategy to ensure it meets your investment objectives and risk tolerance. No representation or advice is being made as this presentation is for educational purposes only. All right, so now the process. So, really, before we design anything, as far as whether that's an indicator, we really have to think about the process and the performance objectives, which is really determines what type of concept that you want to deploy from a systematic or strategic perspective anyway. And then you have the certain type of market. Do you want to trade leverage or a margin accounts or markets such as futures, FX, or stocks and ETFs? Which market best replicates or is in line with your concepts that you have and your performance objectives? And then it's the asset. So which asset really represents the concept's characteristics, frequency, holding periods, whether that's intraday, swing, long-term, and then also that also matches strategic concepts. So you have to match everything, with the strategic concept, frequency, asset, margin, or market, variation of value. So this is kind of related to frequency in some respects. Whether or not you're going to choose to exploit random variations of value or cyclical variations of value, and then that can determine your holding period as well. Alternative objective. If you deploying multiple concepts within a portfolio, what's the correlation? You want to diversify strategic concepts just as much as you want to diversify the markets and asset sectors, etc. And then obviously outcome diversification. So you want to diversify the variations of value, the strategic concepts it is that you're exploiting. So we really focus on, we try to view the markets in a different perspective, within our analysis, even when it comes to using, regular functions that come with every trading platform. So, it really comes down to breaking analytics down into certain categories. So you have characteristic behavior analysis, what's the reverting or momentum or trending characteristics of the market, cyclic session frequency patterns. You can do some FFT analysis to determine what the frequency strength. We found in our research that the majority of U.S. markets have a frequency strength between 42 and 48 minutes. So we typically use within our frequencies or time frames that we use to trade, typically 45-minute increments. Anything below that, we just divide it down into 15-minute increments. Match analytics to strategic concepts. So a lot of times it's, especially in the beginning when you're first designing a concept, a lot of times it's reverse. So you have you're using an analytic method to determine a strategic concept. And so we do things a little bit differently. We want to use the most efficient analytic in line with whatever strategic concept that may be, whether it be momentum or reverting. And then separation of supportive factors and pressures. So, for instance, the generic momentum function in most platforms is just close minus close, or variable minus variable, divided by length of a certain, look back length. Okay, so we divide that. That's just telling you, it doesn't give you very precise information. So we want to separate, directional momentum, and directional pressures, whether that's, upward movement, all upward movement, and all factors that support upward movement versus downward movement, and all factors that support downward movement. And you want to do this on multiple frequencies. So you're just not looking at, one look back length or, one time frame. Random and cyclic, again, all these methods are applied, again, to multiple frequency. You want to do that to random and cyclic to gain a more clear picture of the overall market. And then dynamic adjustments and controls. So, instead of using a set look back length, that can be based on the amount of time, bars, volume, etc., that are within a market cycle, or within a certain movement, or within a certain condition. So, and then dynamic custom variables. So, the variables themselves can also be dynamic and adjusted on a per bar basis. And then market classification. So this is kind of instrumental to us. We use market classification very heavily in the majority of our concepts. We don't necessarily use it to derive alpha. We use it more within the OSL structure. So it's order statement logic. Market classification, we typically break down into 32 market environments and substructures. And then that allows us to be more precise within our target prices and exit values that we're seeking, per market classification. So we wrap that within a strategic concept to improve overall efficiency. And then OBOS, overbought, oversold. Obviously this applies to, price, volume. It's not just price movement. It can apply to, cyclic movements, summation of cyclic movements or values within a movement. And then internal efficiency loops. This is also another critical factor for us, because we have a firm belief that, creating a system all in of itself is fine, but you want to give it the ability to, internally analyze itself and then make adjustments accordingly. And then value identification and OES. Okay, so value identification again is random versus cyclic, and that can even come down to a momentum type of trade. You still have value associated. You can be looking for larger frequency momentum and smaller frequency value. So you can combine two different concepts to increase overall outcome, efficiency and consistency. So. And then this is performance patterns and correlation. So again, that kind of goes back to internal efficiency loops. So, we use internal efficiency loops to track, the system's trading performance, each model as if it was all trading live. And then we use that to, adjust the OSL structure, so the order statement logic, to identify when, an entry was, could have been a little bit better, or an exit could have been a little bit better. And then you also have performance patterns and correlations that kind of go into that. For instance, let's say that you design a multi-model structure, and model 10B has been performing very well, but historically speaking, after model 10B has performed very well for a certain amount of time, you have an increased probability that model 4A, for example, may be the next optimal model if certain characteristics are identified within the market. So it gives you another data stream, so to speak, to apply some analytics and some intellect within a systematic structure. So indicator function and objectives. Again, this kind of reverts back to matching indicators to a concept instead of the other way around. So you want to be creatively simple, right? If you believe in the works of John Conway and the rules of complexity, it's creative but simple and direct. Test methods for efficiency, lag, correlation, predictive power. This is also very important. You want to find out which functions, which analytics, offer the most efficient way for a specific purpose, right? And so, combination of analytics, this means practically, you don't want to design a concept using the same methods. It's not giving you a real clear picture, even if they're applied, across multiple frequencies. And so interpretation mistakes. So this is a big one for discretionary traders. You want to have a clear, precise way to identify when a signal occurs, right? To eliminate subjectivity. Some of our strategic concepts really involve fundamental behavioral and historical justifications. One thing that we found that if a concept isn't justified by those things, QTFB, so it's quantitative, fundamental, behavioral and historical justifications, really one of those actually flips over and then becomes a risk factor, right? So you want every, strategic concept to be justified fundamentally for that. And then obviously, again, market classification. We use this heavily within every system. Momentum reverting, correlation and spread. This one, is more based, with futures that share a specific correlation, ES, Dow, gold, silver, and then obviously we use a specific type of stock concept derived from kind of alternate perspective, I guess you could say, of game theory that relies heavily on correlation analysis within stocks and ETFs. PVMV, which is price, volume, momentum, volatility patterns. This is also used more so within market classification methods. And so, and here are some of the systematic structures. So you have, on top, if you could imagine, you have the strategic concept, right? Whether that be, momentum, reverting, correlation, spread. And then you have, market classification to determine the optimal value, right? The optimal target price for that identified market environment in the substructure. And then dynamic money management. For futures anyway, it's a little bit more difficult, to deploy, all the money management options that we have. However, within stocks and ETFs, it's more feasible. And so you can get really creative with dynamic money management, especially when you allow multiple entries per position, right? Because this gives you the ability to diversify the factors that's producing outcome, such as random and cyclic variations of value, but also, it gives you the ability to choose, how many shares, how many entries per position, then per condition, or per, classification. And then order statement, logic, and loops. Again, this it reverts back to MC, and then using internal performance analytics to make a constant improvement to the underlying logic or target prices that it's aiming to exploit. Then you have profit exits. So we we really want to give the system, the systematic concept or model as many ways as possible to exit profitably, right? We want to, all of which should be dynamically adjusted. You know, some exits push, know when to push to extend profits, and then know when to mitigate losses by getting out with a smaller profit. And then you have loss exits. Again, you need to know when to take a small loss, and then you have, obviously, you have your max losses, your max stop loss. But a lot of times, if you can take a small loss, if a certain condition occurs or certain criteria is met, sometimes it'll keep you from hitting your max stop. And then MPLs. MPLs is exits or non-profit and loss exit models that don't even look at profit and loss. They just identify a market environment, condition, criteria. Something has occurred within the market that's not very conducive to the model or to the underlying target that's applied to the market. So we go ahead and exit. So here's some indicator categories that we list on our site. By expansion, contraction. Again, this applies across every form of analysis, right? It's just not price. It's just not volume. It can be cyclic movements. Then directional momentum. Again, splitting. Pressures, pressure momentum. Some factors that support positive movement or support downward movement. Variable deviation. So we want to identify when variables are deviated, and those can be dynamic. Strength of movement. This applies for especially on multiple frequencies, when you're looking at multiple frequencies of how to identify whether it's just a single frequency momentum move or if this is happening across multiple frequencies. So again, that kind of reverts again to frequency strength. Trending versus reverting characteristics. This is also important because it determines the strategic concepts, the optimal strategic concepts that you apply to a market. So you want to first, that's one of the first forms of analytics that you want to apply to any asset that you're considering trading. So before any strategic concept is designed, so to speak, you have to perform a first round of analytics to configure whether or not if what you have in mind will even work. Market classification or pattern classification and matching. This can also go to Fibonacci levels, directional bias and probability, distance, duration, prediction. Again, using historical analytics and identifying certain market environments and substructures. If certain criteria is met, what's the predictive power of repeating patterns? Volatility variations, not just simply price, but volume as well. And again, this reverts back to encompassing multiple forms of analytics within a single indicator. And so SR value or support and resistance value identification. So it's SR value identification helps in multiple areas, not just entries and exits, but long and short as well. And so every indicator that we offer is not a standalone indicator. It's actually a very versatile collection designed for a specific purpose, right? And so one indicator may have 30 to 40 different applications. So here's some of the indicator products that we have. Dynamic Site PV1. We tried to make it a little self-explanatory when you're looking at the concept, but what it is. But we also offer an explanation on the site as to what each indicator, the function that it serves, and the versatility that it offers. Again, we don't believe necessarily in offering one-off indicators. They're not very versatile. It's kind of basing things off of perspective of singularity. So we want things to be versatile, to meet multiple objectives. As we all know, traders have a very wide range of concepts, and so in views, performance and risk objectives. So our indicators have to be able to serve those functions, on multiple frequencies as well. So we keep that in mind before every product is developed. And then the Atlas, the 3 Atlas products down at the bottom, those are used along with some of our signal services. And so that's a really in-depth market classification method. And so, again, conceptual justifications for some of our systematic concepts. Long-term linear bias, long versus short. We want to match the number of, the ratio of movement, so to speak. Fundamental, behavioral. For instance, a fundamental justification for Walmart, for instance, for systemic risk conditions would obviously, when people shop at Walmart, they just may purchase a different type of product in that environment. And so the behavioral justification for that is obviously it's a defensive stock, and so portfolio managers typically have 2 different rebalancing schemes that they deploy, growth versus defensive. And so that's a defensive stock. So they'll rebalance the portfolio, of which Walmart would be one of those. And so you have fundamental and behavioral justifications for, certain types of concepts that can be outlined or supported. And obviously you have technical or quantitative. And the important thing is that, these technical and quantitative analytics can be tested. Outcome diversification. We don't want our outcome to be correlated or dependent on a single strategic concept, a single model, whether that's alpha or beta, a single variation of value, right? And so, we really want to exploit both random and cyclic variations of value within a single construct. Then risk mitigation. This obviously can come from some exit logic mentality, but also from position, strategic, asset, and portfolio, right? And so that's really how you have to look at it. When designing a strategic concept or systematic strategy, you have to step back and say, okay, how can this fail? What are the risk factors? And that's one reason why we, unlike other firms that use machine learning to derive alpha, we do not, right? So we use machine learning in a slightly different way. We design the underlying sources of alpha ourselves. Again, creatively simple concepts. However, we exploit complexity within the systematic structure side of things. So we design multi-model or meta strategies, so to speak. And so that way, if a single concept or systematic strategy starts to fail, we're not dependent on that. And a lot of times, it's not a negative switching mechanism. A lot of times it's a positive where, a model just starts to perform better than the current model activated. And so, and that reverts to internal analytics, being able to capture and analyze each model's performance as if they was all trading live. And that gives you, again, another data set of analysis to draw correlations to market environments, market conditions, price structures, etc. So at Optimize Your Trading, we offer adaptive strategy templates and full systematic strategies. They're both offered with, we have open and closed code options. We actually prefer you to take advantage of the open code, and then that way you can learn from our systematic structures, some of our perspectives and how we view the market, but more importantly, how we view the process of designing a systematic strategy, so you're not dependent on a single strategic concept, so to speak, right? And so these are, we have the OSL market classification template. a money management template, an ad entry template. All right, the ad entry template is for, I would say, it could be used with futures, probably more so with micro concepts or micro markets. I'm sorry, than with mini contracts. But the ad entry is especially applied to stocks and ETFs. MPL, LXSX, which is an exit model that's not based on profit or loss. Then you have your profit models. That's again another template. And then we have 3 full systematic strategies. PBMV recognition MC8, GT Core RC MC8, and then MPV Force SR8, right? These are different. We pair market classification methods within each system, and then it's combined with a certain strategic objective, okay? And so, and then eventually, you could get to the point where you could actually combine concepts, but each one of these is designed to work in and of its on its own. It's only entry logic only, but exit logic is sent in a separate model, so to speak, but it comes paired with exit logic. And so here's some executions of some of these concepts on ES and GC futures. I apologize for the screenshot. I couldn't really zoom it in very much closer than that. But here's some of the performance results for ES, GC, and Johnson & Johnson. I should say simulated performance, I'm sorry. And so signal services. This is a new service that we're about to offer. We deliver via text and email, right? It's updated daily at market close. Obviously, that's a little bit different for equities versus futures. Specific entry and exit targets are met, and those are offered and dynamically adjusted daily. For instance, let's say that you have an open position, and it has, as soon as the position is placed on, it comes with 2 exit targets, right? One is a profit, one is a loss. The bar closes the next day, that target will update, right? That target updates daily until the position is closed. Everything that we do is dynamically adjusted and based on current market environments and substructures. So we have mini futures, single entry, ES, RTY, and Q and GC. Micro futures, multi-entry, ES, RTY, which is Russell and NASDAQ. And so the the micro futures, multi-entry, those will offer a 6 and a 10 contract variation. And so the multi-entry is also dynamic. It's not the same. It's not 222. 2 contracts per entry for the same. It's all dynamically adjusted. So that can be 1, 2, 3, 3, 2, 1, 1, 1, 2, 2, whatever that is. So that's based off current market environment and substructure as well. ETFs, multi-entry. Stocks, multi-entry. Again, everything with stocks and ETFs, we try to do multi-entry because it diversifies the factors that produces outcome, and finding ways to produce consistency, is of the utmost importance. And so, really, when we started our firm, we stepped back and looked at how other firms fell, so to speak, or other concepts fell, and really, time and time again, it comes down to outcome being dependent on perspective of singularity, so to speak. So. And so we're also offering a value edge trading service where we use our in-house methods along with it's a variation of Atlas. It's a little bit more tuned to each market because, again, our concepts, our indicators, our signal services, trading services, etc. They're all tested. They're all tested and tuned on a per asset, per frequency. And again, we offer, as you can see, entry levels, exit levels, and then target prices for each. 2 target prices. We offer a random profit target and a cyclic profit target for each frequency. And so the Atlas the VLX and VSSX, that is applied to to every market. You can lease the service for a monthly fee, and then also purchase the indicators that can go along with it. The indicators come untuned. They're in a very general format. That's kind of, I tested across multiple markets, and I kind of found the settings that works the best, across all markets, and that's how it's delivered to you. That being said, they're fully customizable, so you can, you can use them, apply them, update them for very specific frequencies, for very specific objectives and markets. And again, these are updated daily. So, we created a page, we give you a login, you log in every day, and then you take a look at these entry and exit levels. We give you 5 entry levels, three exit levels, which are the X1, X2, X3. Those are based off of price analytics. And then the profit targets is based on probability analytics. Relative to the current market environment. So here's the difference with stocks. And with stocks, we show long only, right? We only offer long only. So even though I guess maybe you could still use X1 through X3, in a resistance matter, obviously. But for value edge futures and ETFs, FX, and Bitcoin, we offer long and short entries and exits for both. And so you see the difference between the two. A little bit more information. And again, both are offered with 2 different frequencies. And so, we really wanted to offer a service that meets multiple objectives. And we know that how important it is, to analyze, multiple frequencies or time frames. And so we wanted to, it wouldn't be a very clear picture if we just offered one or the other, right? And instead of just breaking it up into 2 different packages, we thought, the service would be more, actually usable and applicable to someone if it just came all in one. And so we thought that would be a better product for the end user. And so again, reverting back to, all of our analytics are tested. All of our indicators or signal services, et cetera, are tested for validity. And so the picture on the left is the AT&T with a set share or a set entry. There's no dynamic money management applied to that. So, it's the same amount of shares, single entry, one-off system. And then the one on the right deploys multiple entry and our compounding money management plan. So it's a little bit different. However, I would say this: whenever we initially test our concepts, we don't want the outcome of our concept to be reliant on the robustness of our money management. We want that to be dependent on the underlying strategic concept, right? So we never initially test anything with any type of dynamic money or intelligent money management concept or model attached to it. So, we want again, the robustness to come from the underlying strategic concept and the sources of value that we're aiming to exploit. So here's some market examples, again, of what we're looking to accomplish. As you can see, with large caps, we tend to focus on a certain type of large cap, again, because our proprietary GT concept, a lot of consumer discretionary, consumer staple stocks are, exude characteristics that are very close with in line with our concepts and work very well. So, but that being said, we have other concepts that's applied, and again, every systematic structure or signal service, so to speak, is diversified strategically. So it's not simply variations of the same concept. So, for instance, like if we revert back to one of the products that we offered earlier in the slide, it's not. We believe in diversification, taking the cap in kind of philosophy, so to speak, but doing that within a systematic structure. So even, each systematic concept really comes with 4 to 8 underlying models or strategic concepts. And so as you can see, Microsoft, Apple, Facebook, Walmart, etc. And then ETFs, we stick with the majors, index sector ETFs. All spiders can be offered upon request, right? So, and then futures, long and short. Again, stocks is long only. ETFs, futures, FX, and Bitcoin are all long and short. ES, NASDAQ, Russell, crude, gold, and 10-year. And then all FX is offered paired with US dollar. So we stick with the majors there. And then we obviously offer a Bitcoin structure as well for value edge, right? And then again, that service looks like this. So that's how it's delivered to you whenever you log into the site. These price levels are there, and we also recommend, because these levels are produced daily and they change daily, we highly recommend that you take a screenshot every day and then save it, and then that way you can use the previous week's worth of data as well to derive whatever works best with the objective that you're trying to deploy, whether that's scalping or intraday or short-term or long-term trading or investing, so to speak. So we highly recommend to save the data. Eventually, we'll be able to do that on our site. That's something that we're currently working on adding to the service. And that's it. So we are finished.
All right, thank you so much. Well, you do have a couple of questions.
Absolutely.
The first question is, will these products or services work in Indian markets as well?
Indian markets. It depends on which which products and services are they referring to. The systematic structure or the signal services are for set markets. The analytics can be applied to any market. We recommend that they be applied to a chart type that offers directional volume or directional ticks, upticks, downticks, so to speak, because then you'll be able to exploit full functionality.
All right. Did that answer your question? All right. Okay, good. Any other questions?
Oh, the red or darker red?
Yeah, sorry, Brian. He said that he will connect with you for more details.
Yeah, that's fine. We have an open door policy. Anytime you have any questions about any of our concepts, products, services, whether that's systematic strategies, signal services, value edge, you're more than welcome to give us a shout. We'll be more than happy to answer any questions that you may have.
All right. Any other questions? All right. We still have like 15 minutes available.
Can you focus on three symbols such as ES, NASDAQ, and RTY? Yeah, sure. So, again, we really focus the majority of our futures work is on indexes, and there's an underlying justification for that. Those markets, exude, similar long-term characteristics, but obviously they're different enough, even though they're correlated. NASDAQ, is obviously much more trend, much more momentum-driven market than ES, and again, there's a fundamental justification for that as well. NASDAQ is not as diversified as the ES. There's a lower amount of stocks within the index as well. So the ES is a much more reverting based market environment, and actually that works very, very well with value concepts, and we really, really like value concepts, whether that's random or cyclic. So ES, actually, if you look historically, even though that we don't use price characteristics that are really pre 1997 within our analysis, we don't really foresee price price movements going back to how it was before then. The internet connectivity really had a big impact on overall market structure, so to speak. But so you see throughout time that if you deploy a value concept on the ES index, that concept tends to perform better as time goes on. And when you're analyzing performance of a strategic concept, if it's just a single model that's exploiting a very single underlying signal or alpha or beta or whatever, you want to see that curve kind of improve through time, which means that the market's characteristics is not fading, right? It's actually growing strong. The correlation to your underlying concept is actually growing stronger. And so again, that's another reason why we really focus majority of our time on literally biased markets, even though that our market classification methods can be applied, and our analytics can be applied to any market, especially FX markets, to determining random and cyclic variations of value. And again, all of our Atlas or signal services or value edge, all of that is dynamically adjusted down to, we classify things in, again, the 32 market environments and substructures. So some of those are different per market, because each market can have very different characteristics. So we don't apply the same extract the same information differently from every market, because there's more effective ways to analyze some markets than others.
Wow, excellent, Brian. One other question comes from Samantha, and she's asking, can you zoom in on the slide where you have the chart and the model, and explain the entries and the exit signals?
Sure. Hold on one second. Yeah, so the chart on the left, the chart on the left is the same concept as the chart on the right. It's the same model, right? The only difference is on the chart on the right, we've actually applied a dynamic and compounding money management plan, right? As well as it's also multiple entry. So each position can execute multiple entries per position. And really what that does is whenever you have a single entry, single exit, your outcome is dependent on that single entry, single exit, right? However, when you allow multiple entries per position, right, that actually diversifies and increases your probability of positive outcome, right? Obviously, you don't want to do that in every environment. You only want to do it when, in certain environments, but and that again can be dynamically adjusted. We're a firm believer in multiple entries, because it really does wonders for improving overall outcome consistency per trade probability. So it starts with the per trade probability, and then it works to the system, the asset, and then the portfolio. And so we focus on effective or efficient concepts in that manner, right? But this is AT&T, so we focus primarily on large cap blue chip stocks that display a certain type of characteristic and systemic risk, right? And so we want to deploy a certain type of value concepts there. A second data stream is used within analysis too. We analyze the SPY ETF.
All right, excellent. Any other questions for Brian? All right. So Brian, can you tell us again where all our traders in here can contact you and can get a hold of you?
Yeah, sure. So Brian at optimizedtrading.com or Robert at optimizedtrading.com is my business partner. Our new website is optimizeyourtrading.com. We just launched the site. It's actually not even picked up by Google yet, but we've been working really, really hard to offer a wide array of products and services, and not only just a wide array of products and services, but to ensure that each product that we offer serves multiple functions for each trader, right? So it's just not it's just not a one-off type of product, so to speak. But optimizeyourtrading.com, again, open door policy, more than welcome to give us a shout anytime.
Brian, you have one more question. Kevin is asking, what platform is the code in?
Yeah, well, our platform, or that code that I just displayed, that was in EL. That's a TradeStation. There's some workaround solutions. We've designed some workaround solutions for our internal analytics. Obviously, EL, we understand that EL is a slightly restricted language, but again, it's very versatile. A lot of product distributors, a lot of brokers accept EL or TradeStation or multi-charts. So again, you can purchase I think it's the multi-charts that's compatible with EL, so it's available on 2 different platforms. However, products are available on NinjaScript as well for NinjaTrader.
All right, excellent. Thank you so much, Brian. A lot of valuable information in your presentation. Should you guys have further questions, please email him, Brian at optimizedtrading.com or Robert at optimizedtrading.com. All right. Okay, so if you guys don't have any other questions,